So guys, we'll get started. We appreciate everybody joining us. As we said last week, we expected a lot of changes in the market. Last week, we talked a little bit about what we knew regarding Fannie and Freddie, credit changes, forbearance. As everybody knows, on a daily basis, things seem to be moving very fast. So we thought we'd get everyone together and give you an update on where we're at, kind of our little state of the market for today. On the call, we've got Old Capital team. So we've got Paul Peoples, Dave Walls, myself, Ricardo Hinojosa. We got James Eng with us today as well. From our Fannie Mae partners, we've got Fritz Waldvogel with Doherty Mortgage. We've got the Sabal team on the line, Jason Hull and Ricky Mirabito. And then we're going to wrap it up with some words from Grant Williamson with DBG to talk about things from an appraisal perspective. So we will kick it off. Okay, from an agenda standpoint, we're actually going to take it up and start a little more, high level today. We'll get into a lot of detail regarding Fannie and Freddie, but James Eng did a really good video. I think he put it out last week on his YouTube with some lessons learned from a memo that he had pulled together from Trammell Crow. I guess there was a memo that came out in the late 80s. I'll let James kind of walk through some of what he thought were some of the key points out of that memo that I think will resonate with everyone on the line, given what we're going through right now. And then we'll switch over to Fannie Mae with Doherty, talk about some credit updates, some big changes to the forbearance program and kind of their take on that. We'll do the same with Freddie Mac and Fannie Mae small balance. And then we'll kick it over to BBG. Grant Williamson is going to talk through some of the things that he's seeing from an appraisal standpoint on inspections and his take on impact evaluations, given everything that's going on right now. So we'll kick it over to James and talk through the lessons from Trammell Crow in 1989.
So I actually saw this come out probably like a week ago, and it really was around one of the top executives at Trammell Crow. Essentially in 1989, when the market was in the dump, he sent a note to all his executives and said, hey guys, we've been through some of the toughest times in the last 3 or 4 years, and it's been tough, but what would be even worse or would be a shame is if we didn't document what we learned during this time so that the tough times would be better the next time, and then what should we be doing in the good times? So after we get through a downturn, what should we be doing in the good times? So let's start on the tough times, because I think the next 6-12 months are going to be tough times. So let's start there. And then the second slide, we'll get into the good times, what we should be doing. Okay, so tough times, I picked 5 things. And this really comes out of about 100 pages of emails that were back and forth between executives. So number 1, tough times, a lot of them talked about cash and how once you send out cash to your investors, in terms of distributions, it never comes back. So cash is king in this time, and failure to retain that cash is going to be trouble not only for your property, but then also it impedes your ability to capitalize on opportunities coming up. So everybody who's on this call, we want you to make it through this particular tough time. But then on the other side of this, there's going to be excellent buying opportunities. So number 1 was cash was king right now. Number 2, negotiation. And their quote was, document everything, because whether it's a deal on a property or a deal with a lender, if you don't have it documented, it never happened, right? So document everything. Number 3 is debt. And a lot of people will deal with lenders that are, I would say, second or third tier, and they're trying to save like 0.1% on their interest rate, right? But in this time, the lenders that are going to work with you through this situation, they're worth a ton more than that 0.1% on interest rate. So work with top lenders like you have on the phone today, because relationships matter during this time and tough times. Number 4 is timing, okay? So there's going to be deals that come out right now, and there's going to be a big spread between what sellers want and what buyers want. And it's going to take some time to get that timing on exactly when buyers should be buying. So don't go out and buy too soon in tough times. I think it's a little bit too early right now. And the same way that we're buying properties, when you go out and your tenants are shopping for rent in a declining market, you have to be able to adjust quickly. All right. So I was at a property about a month ago, and we went and looked at a unit, and it had been on the market for 6 months. And I said, what the hell is going on? Like, why has this not been leased? It was a brand new unit, great rehab done to it. And they essentially said, look, we've been holding out for premium rents. And the rent, it was a 1 bedroom at 1,050. And as soon as they dropped the rent to like $999, it went in, 1 week. And so in this market, you can't do that. You have to be constantly checking your rent comps, figuring out, and don't be holding out for premium rents. And Trammell Crow knew this because, or they felt it even more because they were in the office, industrial, retail space. And if you didn't get a tenant this year, you didn't get them for 2 to 3 years in a downturn. But even as apartment owners, we have to do that. And then also one of their last quotes was, when you bottom fish and you don't have the staying power, which is cash, to ride it out, you turn into fish. And so make sure that if you come in and you buy a deal and it's on replacement costs and it's not cash flowing right now, make sure you have the staying power just in case this downturn takes a little bit longer. And then the fifth thing on tough times, acquisitions. A lot of people are going to be looking to replacement costs, because if a property goes from, let's say, 90% today all the way down to 60 or 70% occupancy, it's going to be hard to buy that on a NOI divided by cap basis. So make sure in a down market, you're looking at replacement costs versus the purchase price. Ricardo, can you hit the next one? So as you go from tough times to good times, right? So whether this is going to be 9 months, 12 months, 18 months, there's going to come out the good times, right? So acquisitions, their motto, they did a lot of deals very quickly. And a lot of their executives said we should have done fewer deals and did them better. And don't solely focus on the next deal, but you got to have prudent asset management throughout. That's number one. Number two, portfolio management. And this is really looking at your entire portfolio and figuring out, what should I be selling right now? And so this might be, maybe you sell in year 2 or 3, even though it's a 5-year hold, because if you could get a fair price, one of the things that they said was, one way to stay financially healthy is to sell too soon. And you might leave a little bit of money on the table, but if you hit your returns, you need to sell. Number 3, in the good times, don't let success lull you into a sense of complacency. All right. So a lot of times people, right now, you cannot, in the good times, it was very hard to tell who were the good asset managers. But right now, in this month, in this time, this is where you tell who can really bang the doors and get collections, right? Or get on the phones and get collections. So that was number 1. But then also number 2 on focus is be close to the market, right? So tuning into these webinars like this to make sure you're in tune with the market, but then also being in tune with your staff at the property is huge, because Trammell Crow had signed a bunch of nice leases in high-rise office buildings, and they got further away from their industrial clients, and they sort of lost touch on a lot of their deals. Number 4 on good times, move to non-recourse as soon as practical, right? And so on development deals, they almost always had to sign recourse, the same way that you might have to sign recourse on a deal if it's not stabilized, right? If Fannie and Freddie can't do the deal because it's not 90% occupied, you might have to do a recourse loan in the short term, but as soon as you can, move over to a Fannie or Freddie loan. And then number 5 is team. So stay lean, even if you can afford to get fat. That is, pushing the existing staff to do what they can. And then one of their things, even on the industrial and retail side, was a superstar in leasing in terms of an agent is of greater value than an unlimited number of mediocre performers. So as you go out there, leasing is going to be harder, collections is going to be harder. So finding and retaining those superstar agents are going to be key in the good times and even right now. So that was it. Those were the 10 lessons that I got out of sort of listening and reading what Trammell Crow went through back in 1989, which was one of the toughest times here in Texas.
Fantastic. Thank you, James. Great find. And thank you for sharing that with everyone. So now let's move into kind of what's going on today. So we're going to start off, like I said, we're going to touch on Fannie Mae and Freddie Mac. We're going to start with Fannie Mae. And Fritz, if you want to unmute yourself. You there?
One thing I would say, James, is if you could stay on, we may have some additional questions for you in a little bit.
And in regards to questions, guys, go if you do have questions, use the chat, and we will answer them as it makes sense to answer them, or at the end. So Fritz, go ahead and unmute yourself, and we can get started.
All right. So obviously it's been pretty volatile times the last 2 or 3 weeks. So thanks for setting this up, Ricardo and Paul. I think even from where we were last week, I think we already know a lot more in terms of the forbearance agreement. But just to kick it off, I thought it would be beneficial to at least kind of go through some credit changes with Fannie Mae. I think the number one biggest thing is now on any new business, they're adding full interest and principal reserve for 12 months on deals greater than $6 million loan amounts. You're going to have a 12-month full reserve for principal and interest, 12 months of taxes and insurance, and 12 months of replacement reserves escrowed at closing. If you're under $6 million, that the only difference really is it's 18 months of P&I instead of 12 months. And that's on deals above 65% leverage. If you're at 65% leverage, they move that down to 6 months across the board. So obviously that's a big change. Those funds are really to be held at the lender for basically at a minimum 12 months. It's really a 6-month lockout, and then it's 2 consecutive quarters at above a 125 coverage on a higher leverage deal, or at 65% leverage, you're at 135 coverage. So that is to be held by the lender, and you can use those funds towards your P&I payment if you can show that you really need it. So you need to show that you're below 1.0 debt service coverage and really need the funds. Supplemental loans across the board are kind of off the table at the moment. I think the biggest issue with supplemental loans are you need to escrow P&I for both, not just the second lien, the supplemental, but also on the first lien as well. So that just becomes, it just doesn't make any sense. And I would say even on assumption supplementals, we've seen Fannie push back at even doing any sort of supplemental. And then the last piece, if you are in an interest-only period, the P&I reserve is assuming the full 30-year amortization, not just the interest-only period. The exceptions really, I think for the majority of folks on this call, I don't know if this applies too much, but if you're at 55% leverage or lower, new business, they'll waive those requirements altogether, given the obviously a little more conservative loan amount. If you have true, we call them big A affordable, multifamily affordable housing deals, so 100% Section 8 HAP contracts, they don't require it. If you have more than 8 years remaining on tax credit property, and also if you have deals that are existing that are rate locked or already have a loan commitment. And I think at this point, you probably don't have many of those left. But if not, if you had deals that were in process, I think it's been a pretty painful period over the last few weeks, just given the fact that that's a pretty material change, after you've already started the loan process. So as I mentioned, in terms of the reserves, the release test, it's 2 consecutive quarters or at the latest 36 months. And as I mentioned, you can draw down on the reserves by the borrower, assuming that you really need it and you can show that you're below 1.0 debt service coverage. Couple other material changes. I know a lot of people on this call utilize the streamlined early rate lock program, which allows you to lock early in the process on the Fannie Mae side. I think given all the volatility in the marketplace, Fannie Mae did away with that program for the time being. I think they're concerned, obviously, with many of us on this phone call, is really to see how collections look in April and May and going on. So I think they don't want anyone to take material risk, because obviously you only have a 5% variance in loan amount once you lock. I think in general, at least in the DUS program, the Fannie Mae DUS program, I think the focus is on deals greater than $3 million. They're really not going to do any waivers outside the box, the typical DUS box for loans under $3 million. And then I would just say in general, we've seen a pullback in credit. The days of 75, 80% leverage and 5 years of IO I think are gone for the time being. I think a 75% LTV loan is still doable on an acquisition with a couple of years, 2 to 3 years of IO on a 10 or 12-year deal, depending on location and sponsor, obviously. A couple other volatile things over the last week, even since our call last week, is pricing. I think we've seen pricing come in significantly from where it was probably about 2 weeks ago, where we saw, note rates, all-in note rates on Fannie Mae product, up in the high 4s or low 5s, all-in interest rate. I think now we're seeing 10 or 12-year deals in the 3.5 to 4.5 interest rate range, just depending on, asset class size. But they do, so obviously with the volatility in the treasury markets, Fannie has implemented floors in terms of the treasury markets. So on the 10 and 12-year terms, right now you have a basis of a 90 basis point base treasury rate. So basically, even if the 10-year treasury, which I think today about right now is about just under 60 basis points, they'll basically just gap out that spread, just assuming a 90 basis point 10-year treasury, just given how much volatility has happened in the treasury markets. And then the last piece, which is new, is Fannie added a delivery fee. And I believe, Freddie, I think, has had this on for a while, but for loans greater than 6 million, they're going to charge 10 basis points at closing. And then if it's smaller than 6, it's 5 basis points. So that is different. All right, sorry, flip that around. Loans less than 6 million, it's 10 basis points and 5 basis points on over 6 million. So that is a change. I don't think it's, huge extra fees, but I just think, it is something to know. Before I move on to the forbearance, any Ricardo or any old capital people have any questions?
Not on my end. Paul, anything on your end that you wanted to get into here before we get into forbearance? Let's see, we've got a question here from Mr. Chalmers. What is the delivery fee? Can you go into that a little more, Fritz, in terms of how that's charged? Is it in the rate or is it an upfront fee?
It's paid at closing.
Okay.
Commitment. Yeah, it's just due to some extra costs that the agencies have to go through in the back end. And I think Fannie just recently has instituted, a fee just to help cover some of those costs.
Got it. Quick question here from Nick. Any idea how assumptions will be treated if the down payment is less than 20%? i.e. someone who just wants to get out?
So I forgot to mention this. On assumptions with no supplementals, there is no P&I reserve required. So if it's just assuming the existing debt, you don't have the big P&I deposit. But also, if you do, right now I don't really see Fannie doing mini supplementals. But if you do a supplemental, even though say your leverage was 65% and higher than a 135 coverage, you say in this case you'd only have 6 months worth of P&I and real estate taxes and so on. But if the original loan was done at the higher tier 2 leverage or higher leverage, it doesn't matter. It still goes under the tier 2 bucket, which would require the full P&I payment, 12 months or 60 or 18 months, depending on loan size. That's a good question.
So assumptions are fine. What about the nuance of it if the value may not be there and the down payment is less than 20%?
Oh, okay. Then it's just, we'd probably have to get Fannie approval, just given the fact that I would assume at that point the coverage on the original balance could be probably under a 1.0. But ultimately, if it's just assuming the existing debt, we have done plenty of deals where it's less than 20% down.
Good question.
All right, so I'll move on to the forbearance piece. Obviously, this has been a highly contested topic and very talked about over the last 2 or 3 weeks, and I think there has been some changes since the last time we talked last week. Most notably, Fannie has moved on and tried to mirror the CARES Act, which was signed last week, in terms of now, I think in the previous letter that was sent out, you were unable to evict tenants, not just during the period of forbearance, but on the whole period of just truing up on your loan. And so that could be, call it 15 months, say 3 months of forbearance and 12 months paying and becoming true on your loan. They changed that to mirror the CARES Act. So I'll get into that in a second, but that's probably the biggest change since last week. But I do want to, really emphasize with everyone that, the forbearance program, and it is available to everyone to reach out and apply for it, but it's really for properties that are under a 1.0 debt service coverage and really struggling. These are not for deals that, are somewhat performing. So you really need to show that you are under a 1.0 debt service coverage to qualify. So I think we've talked about this a little bit last week, that everyone, we're expecting a lot of people apply now, given the changes in terms of the eviction policy. But I would just emphasize that, it's really for properties that are under a 1.0 debt service coverage. So, do your best. I know we send a list of items that we would need to determine if it makes sense for us to approve it or not, or if Fannie approve it or not. But, they're really for properties under a 1.0 debt service coverage. So it's really, and I know our servicing team is going to send out an updated email with those documents that we're going to need to determine those. But as I mentioned, in terms of the forbearance agreement, you have a requirement to bring the loan current within 12 months of the end of the forbearance period. So that is not, it's just tacked on to the end of the loan term. The principal and interest needs to be paid back within 12 months or at the receipt of business income insurance proceeds. As I mentioned, really the 3 requirements in terms of suspending all tenant evictions for non-payment, it's really tied to the CARES Act. So really it's 120 days from when the enactment of the CARES Act went into place. or at the end of the actual forbearance period. Or otherwise, I know there's some municipalities that are going to require maybe potentially longer suspension of all tenant evictions. So just making sure that you work with your local municipalities, making sure you're compliant. I think the other thing that I think is important that people understand is obviously if you do go into forbearance, you're not allowed to take out any excess cash flow to your property. So essentially, after paying all of your bills, if there's any excess cash, that will be sent to the lender. And also that includes, if you self-manage your property or have a management company that you own that self-manages your property, you will not be allowed to collect a management fee on these assets. So I think that's something that I think's come out in the last week. So I want people to understand the lender will be collecting all excess cash flow during the forbearance period. And if for some reason we were able to have enough cash flow held with us, we will apply those to mortgage proceeds. Like I mentioned, I think just the biggest thing is to communicate. I think we received some feedback from some borrowers that have done a really good job of sending weekly updates on kind of where they stand. I think communication is going to be very key. So do your best to continue to communicate with your asset management contact, at least with us. And feel free to copy me on all correspondence. But I really do believe the more you can communicate, the better it's going to be for everybody. So with that, I'll open it up for any other questions.
Really quick, during the forbearance, so if you have positive cash flow, it goes to you, or it goes to the lender in escrow. And then after the forbearance is over, does it get immediately released, or are there nuances to how that gets released?
It's my understanding that if there's any excess after the forbearance period, are you talking about just the forbearance period or the payback period?
Just the forbearance period.
The excess funds would be released after the payments that are still due during the forbearance period are paid back.
Got it.
So
okay.
It's not the end of the forbearance period.
Okay. Let's move over to, so Grant's with BBG. For those of you, I'm sure a lot of you know him, but he does a ton of work with our clients. We appreciate it. We appreciate you joining us. So Grant wanted to talk through a couple of key points around kind of how he's seeing things from the appraisal's perspective. So Grant, go ahead.
Yeah, thanks for having me on. So we're still appraising right now. A lot of deals that were still in the pipeline are still happening. So that's good. And moving forward, we're still appraising. I mean, it's kind of an unprecedented time, and it's tricky to kind of figure out where we're at, but we're still doing it. As far as inspections go, the biggest thing is we're just trying to be creative. We've done everything from a vacant only inspection to video inspecting with like a manager. So there's other options too. So we're also doing kind of like if we let's say it's a smaller property and there are no vacant units and we kind of want to get a feel, we're doing kind of like an open doorway deal where we kind of open the door and peek inside so that we're not exposing ourselves or any tenants. And for PCA, ESA, they've switched to vacant only inspections for the time being too. So that'll help. But more than anything, it's a case by case basis. It's good to get Fannie and Freddie's input on any deal, but just be flexible if you can. On valuations, short term, you kind of have to look at collections and look at it almost like a lease up deal and say, all right, well, how long until we can get back on track? And so I think we'll just kind of have to take that one day at a time on rent loss. Valuation concerns in the short term. I mean, right now there's no empirical evidence or anything quantifiable of pricing or value because, it's really early. The duration of how long this goes is too early to project. So it could be 3 months, 8 months. No one really knows. So right now, we're not really hammering values just because there is no evidence of it. We're just proceeding with caution and maybe being a little bit more conservative here and there where it's easy to. Long term, again, it's too early to tell. This is, in my opinion, much different than any other recession or downturn we've experienced because it's happened so fast and it's continuing to happen so fast. So, and just as much it could come out of it just as fast. So we don't really know. I think if employment numbers get back to normal relatively quickly, you see that 10 million unemployment figure and it scares everybody, but if that's a short-term deal and we're all back to normal here in a few months, I think multifamily will be in a good spot to keep chugging along. That's about all I've got. If anyone has any questions on inspections or valuation, let me know.
Let's move over to our Sabal team. So Ricky, you want to unmute yourself, or Jason, whoever was going to walk through the pages? I'm not sure.
Ricky was going to talk, but I will talk now. I also have Vartan, who's the head of our servicing group, join us as well. He's getting a good onslaught of kind of questions regarding forbearance, and being the fact that he's dealing with it on a daily basis on the front lines, I figured he'd be a good person to talk to about that. So
excellent.
Real quick changes, and I'll kind of high level. I know that we're running out of time here. High level changes for Freddie Mac: 12 months principal and interest reserves, tax and insurance in pounds for the life of the loan, and replacement reserves for properties greater than 50 units. So what the key on the Freddie Mac loans, I think that to make sure everybody really understands, is the 12 months principal and interest will be taken, whether it's interest only or not, it will be taken at closing. The taxes, insurance in pounds, and replacement reserves will be handled in the typical fashion that we handle those. So, tax and insurance will be handled the typical way that Freddie Mac small balance handles taxes and insurance. Then replacement reserves, which is new for properties over 50 units, which, kind of actually really falls in kind of middle America. They will be taken on, call it roughly 400 to 500 a door, divide that amount per year by 12, and that'll be taken monthly. So taxes and insurance in pounds, nothing different than what has happened today. The 12 months principal and interest will be taken at that. The debt service coverage reserve will be taken at closing, and then the replacement reserves will be taken over the course of that year. So that's a little bit different from what Fannie Mae is doing, but I think that probably gives everybody a little bit of color into how that's working. So I'm not sure if anybody has any questions on that. You can, feel free to text Ricardo. I'm sure he'll hit me up.
Let's keep moving. Here we go. Hold on. Let's see.
So, if you want to look at, the release and reserve provisions, Vartan, feel free to jump in this as well if you want to, but, the release of the debt service provisions is kind of this very similar to Fannie Mae with a couple of slight nuances. It's going to be the borrower provides evidence of satisfactory 80% of the collections for the remaining, for that year to meet the debt service requirements of that individual loan. So, nothing too major on this one. Obviously, Fannie Mae is 6 months plus 2 consecutive quarters of the minimum tier debt service coverage reserve for a minimum of 12 months. Freddie Mac, wants to make sure that people have 80% of the collections for that, that 3-month average leading into, the asking for forgiveness and release of the debt service release provisions for that loan. And obviously, I think that everybody knows, the forbearance with Freddie Mac. The one thing that Freddie Mac actually came out with first regarding forbearance, and I'll touch on this real quick, that goes along with those reserves, is originally Freddie Mac was letting us, was saying that you could have 3 months forbearance and you have, your 6 or 9 months to pay it back, however long it takes you. And during the first initial period of the forbearance, you cannot kick tenants out. And then after you finish your first, 90 days, you can start, evicting tenants if need be. They've kind of come back on that over the last couple of days, which is going in line with what Fritz was saying, which was they're going to be following, local and state laws. No matter what Fannie and Freddie put out, they're going to be, the forbearance will have to model the national kind of CARE Act as well as state and local rules and regulations. So that's one of the things to think about. Commercial income, which kind of a lot of the stuff that, the team, the old capital team, I know you guys don't get too involved in the commercial income, given where you guys place your loans, but commercial income, will not be counted pretty much across the board unless it's, a pharmacy, a grocer, nail salons, things of that nature are not going to be counted. So, this kind of hits more of our, larger, New York's, Chicago's, Los Angeles, places of that nature. But every once in a while, we are running into these deals where it might, you guys might be affected as well. But commercial income across the board is not going to be, not going to be counted. If you look at the Freddie Mac COVID-19 cash out refinance guidelines, 5% decrease to your, your maximum LTV, 75% in your top markets, 65% in your small, very small markets. And it's a 10 basis point increase to your DSCR. So, pretty simple math. 130 in your top markets, 135 in your standard markets, so on and so forth there. The nice part is I know everybody's looking at this and saying, I'd like to max out my leverage in the past. I'd like to max out my cash out refinances. But, the nice part about during times of uncertainty and I think kind of Fritz can speak to this as well, is that, there's not going to be a lot of banks out there that are going to be doing cash out refinances at the leverage and on the non-recourse nature that we are willing to do it. So, given that obviously it's got a little bit more stringent, Fannie and Freddie are still the best games in town for your cash out refinance and for acquisitions kind of moving forward. So it's still nice to have it. It's a little bit tighter, but at the same time, it gives us a little bit more cushion in times of uncertainty with rents and collections and things of that nature. Forbearance. So obviously there's a lot of verbiage on here, and I had Vartan join us today, and I'm not sure if Vartan, can you hear me? Are you there? I was going to have Vartan speak on the forbearance agreement for Freddie Mac and Fannie Mae, just talk about the two of these. Anybody can ask any questions. The interesting thing is, we are pushing for folks, and just like Fritz was saying earlier too, is we don't think folks should be taking forbearance unless you ultimately need to take it. But given the forbearance guidelines, I think people need to be really thoughtful about how they do that and how, who's holding onto your money during that period of time. So Vartan, if you want to speak to this, please feel free.
Yeah, I mean, a lot of it was covered already, so it's it would be a repeat if I went through kind of the whole thing. But just kind of one thing I would say differences between Fannie and Freddie is from the Freddie Mac standpoint, it's easier to be able to qualify for a forbearance, if I could use the word qualify, versus Fannie, where it's a lot more stringent and there's a lot more guidelines and reporting requirements that go with the forbearance. So just kind of keep that in mind. If anybody has any specific questions about either one, I'm happy to answer any questions.
Really quick, just to jump in on, so we get a lot of questions, and a lot of people have been talking about, okay, when's the right time to do forbearance? How bad does it have to get? And we've had a lot of different opinions on it. Paul, what's your guidance on that in regards to, what other measures should you take before even thinking about forbearance?
So the bottom line is, do you need the forbearance or not, right? If you don't need the forbearance and you have cash flow at the property, or you're well capitalized with reserves, you shouldn't just come and ask for forbearance. You do need to demonstrate a hardship, and that's sort of very loose in the CARES Act as to how you demonstrate that. So the agencies, both Fannie and Freddie, have put out some guidance around that as to, how you demonstrate it. And really it comes down to, if you're below 1.0 cover and you're not able to meet debt service, then that's the right time to come and say, hey, I need forbearance, and give some color as to what's going on with the market and the specific property. So don't just come and say, hey, 50% of my tenants aren't going to pay, I need forbearance. Give specifics on a rent roll of who's paying, who's not paying, paint a picture of what's going on, and provide supporting information to demonstrate that you're below a 1.0 cover. That's the right time to do it. So it doesn't have to be done on 4/1. You can wait until 5/1, 6/1, 7/1. So it's not like you have to take it on 4/1. If you don't need it in 4/1 payment, don't take it. Wait till 5/1, and then you'll have more time to know exactly what's going on the property and have a better story for the seller, servicer, or lender.
I mean, Ricardo, this is Jason. The one thing to say on that as well is that Freddie's already come to us and told us that markets that have, high concentration of oil and gas, Houston, Oklahoma, New Orleans, and then other folks that have high concentrations of tourism, Nevada, Orlando, will not be necessarily pre-review, but will be things that they want to pre-screen with us. And, those are the kind of the issues and the situations that we're seeing they're preparing themselves for that, given what's happening in those locations with with COVID-19 for, forbearance as well. So we expect to see more folks coming to us with issues in those locations than any other location as well.
Okay. Anything more, guys, from Saval?
No, I think the big takeaway from, and I don't see Fritz up there, but I'm sure he would say the same thing, is I think that everybody on this call has been doing Fannie and Freddie work. I think that everybody should be really excited about having Fannie and Freddie loans, because one of the things that Fannie and Freddie are putting out in the marketplace, and which is true, is if you don't have a Fannie and Freddie loan today, you're not going to be able to get a Fannie and Freddie loan in times of uncertainty, in times of the downturn. And going off what James was saying earlier, which I think all his points were excellent, which is there's going to be a lot of opportunities that present themselves over this next 6 months to a year. And the folks that took advantage of the last downturn had the opportunity to take advantage of Fannie and Freddie debt. The old capital folks did a great job of getting everybody involved with the agencies and, keeping yourself in good standing with Fannie and Freddie so that you can take, and obviously, forbearance, if you have to do it, you do it. But keeping yourself in good standing with Fannie and Freddie is an important aspect of taking advantage of what's going to happen in the marketplace in the future. Because, obviously, if you take a Freddie Mac loan, it's in forbearance, you're not able to take a loan during that period of time. So I think, going off of what Paul and Ricardo, what James were saying earlier, if you don't have to do it, don't. But, the agencies are open for business. It's still the best non-recourse, highest leverage opportunity in the marketplace. And we're still taking applications on a daily basis. And I think we just signed up 2 Fannie Mae loans today. And, I think they were all about $1 or $2 million a piece. But, we're still doing a good bit of business. And there's a lot of other lenders out in the marketplace that are taking a pause. And this is a time where, the agencies were created to provide liquidity to the marketplace, and we will continue to do that.
Okay, that sounds good. Ricardo, could I jump in here?
Please do.
So I agree with Jason, and we appreciate Sabal's help, and we appreciate Doherty's help in discussing this situation. I've done this for a long period of time, and I haven't seen so many guys with self-quarantine beards and mustaches as I've seen Fritz, who I don't think has shaven for 3 or 4 weeks. And if you saw Ricky on the call, he has a 1970s thick mustache. And so we got to get these guys back to work, as you know. But what I would want to just focus in on, and I'm going to be a little bit of a realist in this deal. So I think that we know April collections are going to be fairly okay. They're not going to be spectacular, but you should be talking to your management company almost every day to see how they are doing with collections and what kind of the feedback is, because you're going to get asked by your loan servicer about what's going on. So make sure you stay on top of what that's all about. They're going to be concerned. Your servicer is going to be concerned for at least 3 or 4 months. So I would have that information handy to them once a week. I also want to bring 2 items into the discussion. One is kind of the original model for Fannie and Freddie with capital calls. And the second one is bankruptcy with Fannie and Freddie. And again, we don't want any of this stuff to happen, but I want to kind of give you a little bit of history and some things to be aware of. And again, if you went back 20 or 30 years ago, apartment lending was really just 2 or 3 rich guys buying a building. Syndication models were not relevant at that time. So whether it was a bank loan or Fannie, it was those rich guys that were buying buildings, and Fannie liked the rich sponsors with lots of liquidity and lots of net worth. And so about 10 years ago, the syndication model came in. At first, Fannie and Freddie did not like it. And again, Fritz or Jason, if you want to jump in, you can help me here. But let me just tell you what my take is, because Fannie and Freddie really wanted to figure out who the real responsible party was, the one that had the operating or management experience, that had the net worth, had the liquidity. They really wanted to really figure out where the equity was coming from and who was bringing that to the table. So Fannie did not like the fractured ownership model at all. They wanted 1 or 2 guys or ladies. They really didn't like to have 15 limited partners. Hell, we got these days not 15 or 20 limited partners. We have 75 or 150 limited partners all putting money into these deals, and they were just not comfortable with it. So it took a few years of convincing Fannie that it was a better model to have more partners than having only a few folks that would step in if there was a financial problem that would affect the property. So they rethought about that, and they kind of agreed hesitantly of going with the syndication model. And so with the numerous limited partners to be added into the transaction, they put a caveat in there that if something were to happen after the deal closed and the property was being operated, but there was not enough money to keep the deal going, that the partnership would do a capital call to raise the funds that was lacking. So to approve a loan with all these limited partners that were not affiliated, connected with the general partnership, they wanted to make sure that you collect with capital calls if that's going to be necessary. So I want to reiterate that Fannie is counting on the general partners to handle any lack of cash with the limited partners with capital calls. Again, they felt that with providing a non-recourse loan in this large syndication model, Fannie wants to make sure that all partners are rowing in the boat, all the the stakeholders and Fannie or Freddie into the same thing. Second part is bankruptcy. I know that Merrill had some information on bankruptcy last night. Again, I don't want to even think about bankruptcy, but unfortunately I was not able to make that call. But some of the things that I wanted to point out to you that I think are important is that these are non-recourse loans and that you signed with Fannie or Freddie or with some of the non-recourse lenders out there, you signed certain carve-outs. And one thing that I want to make sure that we're in agreement with, at least you remember, is that if you go into Fannie Mae multifamily, there's a series of loan documents that you can see the boilerplate form. So go to Fannie Mae multifamily, and then you can look through that and just kind of understand a little bit some of the things you may not recall that you signed, but you signed. And so the obligation, let me just read in this form that I'm going to read off of is Fannie Mae form 6015. It's a guarantee of non-recourse obligations. In item number 4, the survival of guaranteed obligations. The obligations of the guarantor or the guarantee shall survive any foreclosure event, God forbid, and any recorded release or the reconveyance of the security instrument or any release of any other security for any indebtedness. So these are some of the carve-outs, and one of the biggest ones in the carve-outs is a bankruptcy event or any voluntary or involuntary bankruptcy, insolvency, reorganization, arrangement, readjustment, assignment for the benefit of the creditors, composition, receivership, liquidation, marshaling of assets, of liabilities, or similar events of proceedings with respect to the guarantor or any other guarantor to the obligations herein. So what I want to make sure that you understand is that even if you were to file bankruptcy, Fannie Mae in a foreclosure proceeding does not want you to stand in the way if you were going to try to stop them for foreclosing on the property with filing a bankruptcy. So when we talk about bankruptcies, we want to be very careful with that because it may change it from a non-recourse loan to a recourse loan. If you try to stand in the way with a bankruptcy standing on these type of loans. So be very, very careful in that, again, you can read through that stuff on there. So I don't want to be a negative Nelly, but I want to make sure that you understand these are non-recourse loans, provided that we try to do our best to keep the property going. We don't do crazy stuff. And sometimes we may have to give the property back, but they're not going to go after our personal financial statement or balance sheet. So with that, again, we think that this storm cloud is going to last for at least a couple months. We're saying that really don't try to do a forbearance agreement unless you have to. Discuss it with us or discuss it with your servicer just to get the best information out there. Again, because we don't want to see anybody lose any money on these transactions at all. Ricardo, anything else that we want to talk about?
No, I think that we did get a couple of questions. There was a question earlier around bank lending, and with some of what Fannie and Freddie are doing, what are some of the local community banks doing or balance sheet lenders doing?
So the answer on that is we don't know because we're not asking regional banks of what they're doing. My 2 cents is that they're not doing very much. Now I think they're just kind of eyeballing of what is to be expected with valuations and rents. So I think that they'll turn back on here in probably the next 2 months or so, month and a half. The regional banks are probably not the best choice. I would say probably the best choice is really just to really hang low, let this storm pass, and let's kind of figure out what's going on. One of the things I do want to bring up, and maybe James, if you're still on, if I can ask you about this SBA PPP program, can you just give us just a couple words of wisdom on that and what your take is?
Yeah, I mean, there's really two programs that are out there. One is a PPP program, which is really called the Payroll Protection Program, and then the other one is EIDL, which is the Emergency Disaster Loan Program. The PPP program, what we've seen is that most of the people who have, let's say, staff, and you have a third-party property manager, the third-party property management company typically pays the payroll for those people. So if, let's say, you have like a Citygate or something like that, they might be able to file the PPP program and get 2.5 times the monthly payroll paid from the government here in April and May, but it will be dependent on your property management company. Let's use another example. If, let's say, you self-manage your properties and you pay your leasing agent and your, maintenance guy, then let's say 200 unit property, I think this is a good example, 200 unit property, and your payroll is 1,000 a door, 200,000 a year, and then 2.5 times a monthly payroll, let's say it's $30,000. You can apply for a PPP loan today. It actually opened up today. So depending, you have to use your specific bank. So you have to have a business account with a bank. So like Bank of America, I think opened up today their online portal. I think Wells Fargo is down today, but your specific bank, you can go online, apply there, and essentially it asks you like 5 questions and you send it in, and it takes about 5 minutes, and they're going to ask you to show proof of 2 things. One is, okay, was this business in operation as of February 15th? And then also, if we give you the loan, are you going to use it for payroll over the next 2 months? So that's really why it's called the Payroll Protection Program. That's the gist of it, and that's the main program that we've seen come out. It's a little bit harder, I think, if you have a third-party property manager and they have, let's say you have a national property management company that's managing, 30,000 units or something like that. They're probably too big, right? So these 2 programs are for entities that have 500 employees or less. So the PPP and the EIDL. The PPP is the one I think is you can get in terms of a loan, and it can be forgiven if you use it appropriately. Whereas the EIDL loan is up to $2 million. And what we've seen on that one, though, is that the interest rate is, I think, about 3.75%. And you have to show a pretty drastic drop in collections. And we don't know if real estate people will really qualify for that one. And that one you can apply directly with the SBA. So it doesn't hurt. You can apply and see what happens. But I think once it's above a certain amount on that loan, 2 things. One, it becomes recourse, and 2, you might have to put up collateral of some sort. So you just don't want any additional liens on your property. We have Fannie and Freddie guys on the phone here, but they don't want an additional lien on your property if you take that loan. So I think the PPP one is probably the best bet for most people if they can get either their property management company to file it or themselves file it. It's no recourse and no collateral, and it's forgivable. So I think that's probably the best bet.
All right. Is there any questions? Let's see if we have 1 or 2 questions that come up on this. And then if not, we'll just call it a day and everybody can enjoy their Friday afternoon, whatever the heck everybody's doing these days, except for watching Netflix and Tiger King.
I think we're good. I don't see any. If you do have other questions, obviously reach out to any of us. But I don't see. I think everyone on the call is probably anxious to go collect more rent, probably.
Thank you, guys.
Let them do that.
That sounds good. All right. We appreciate everybody being on the call. Again, the Old Capital team, we certainly appreciate Doherty Mortgage, BBG, Grant Williamson, BBG, Sabal Mortgage, and the rest of the guys that support us and support you. If there's any other questions that come up, we're going to try to do this maybe late next week or so, or the following week if there's been any material changes that have been made. But we just want to continue to give you bear hugs and making sure that that we're here with you together. If there's any questions that come up, just make sure that you send it to your Old Capital Loan Officer and also copy me on it too to make sure that I'm in the loop. James, anything else?
Good. What's going on there?
All right. So again, I'm Paul Peebles, James Zhang, Ricardo Internosa, and Dave Walls. We certainly appreciate everybody being on, and we will see you next time.